The seventh video in this series looks at providers. These are the different operators within the financial services market. Thanks for leaving a like and make sure you subscribe for future related videos. Within this video we're going to look at different financial services providers. So we're going to cover banks, building societies, credit unions, national savings and investment, the post office. We're also going to look at different communication methods used by providers, as well as what factors to consider when choosing a provider. So let's start with looking at these 5 main providers of short and medium term products. We've got banks, building societies, credit unions, national savings and investments, NS&I for short, and the post office. So banks, let's start with. They offer a wide variety of products and services. And due to their size, they can afford to invest in new products and services. So many banks will have new products and services coming out often. They potentially operate in multiple countries. A good example of this is HSBC. Of course, it stands for Hong Kong Shanghai Banking Corporation, and they operate across the world. However, a major point to remember with banks is that they have shareholders. Shareholders are investors or part owners of the organisation, and as a part owner, you want to be kept happy. How do you keep a shareholder happy? Well, you pay them dividends each year. Essentially, that is a proportion or percentage of the profit. Alternatively, you maintain a high share price. A way to do that is to keep the profits buoyant, keep the profits stable across multiple years. The problem with banks, of course, having shareholders is that keeping shareholders happy means that they have to make high profits. The people they make profits off, of course, are the consumers, the customers. So theoretically, banks may have slightly higher interest rates for borrowers whilst slightly lower interest rates for savers in order to make high profits and therefore be able to maintain their share price and pay dividends. Building societies, on the other hand, have no shareholders, so dividends do not need to be paid and they don't need to be worrying about maintaining a high share price. Building societies tend to operate within the UK only. An example of a building society is something like Nationwide or the Coventry Building Society, for example. Customers, members, have a say in how they are run. Now, building societies do not have shareholders, but they are run or in place for the benefit of their members, customers. You can go to, as a member who has a mortgage with a building society, to the annual general meeting, the AGM, and have your say into how they are run. A key term which has been a favourite with examiners recently is this one, demutualisation. Demutualisation means changing from a building society to a bank. A number of building societies have gone through this process because they need to be competitive with their banking competition. That essentially means that they're able to then become companies and have shareholders invest in them in order to grow and be more competitive. So demutualisation is when building societies change to banks. The third type of provider we're going to look at is credit unions. A credit union, there's over 300 up and down this country, is where members share a common bond. Now, you get things like the firefighter credit union, for example. Now, what happens? Well, members of the credit union pool their savings to provide loans for other members, and any profits which are made on those loans are then returned to the members who have pooled their savings. They are much smaller than banks and building societies in their nature, and they only really offer 2 main products. You can save with them, and you can get a loan from them. But this is perhaps quite attractive to people who are unable to deal with the major financial providers, such as banks or building societies, for whatever reason. It might be potentially that they've got a low credit score, for example. And it's also a more smaller way to get a loan or invest your savings. So that is very attractive to many people. Next, we're coming on to the national savings and investments. This is NS&I for short, and it's an organisation which was originally set up by the government. The reason why the government wanted to set this up because they were concerned with the amount that people were saving for their retirement, for their old age. And therefore, they wanted to make saving a bit more fun. So what the NS&I do is they offer savings and investment products, savings, investments, but also perhaps the most well-known product they offer is premium bonds. Now, premium bonds are essentially a bit like a lottery. You put your pound in, let's just say you put your pound in, and you get a unique code for that pound. Now, you don't have to remember it. The NS&I, they remember your code for you. Now, what will happen is each month they perform a draw. They do a draw, and whoever's codes come out win a cash prize. Now, that cash prize can be anything from £25 up to £1 million. That means the more you obviously invest in premium bonds, the more likelihood you have of winning. However, there are no fixed interest rates, so you're not guaranteed to make any return at all. So therefore, you have to be quite lucky, of course, to be able to make a solid return from these premium bonds. However, that said, being able to win £1 million, of course, for many people is life-changing, and therefore NS&I premium bonds are quite an attractive option if you want at least the chance of having and winning a life-changing amount of cash. Now, premium bonds, as we said, they don't earn interest, but holders are entered into that prize fund. Funds can be withdrawn with no interest or penalty. And also, premium bonds, you can only invest a maximum of £50,000. So that's something to consider if you have significantly more than that amount. Only investing £50,000 maximum. And finally, let's have a look at the post office. The post office, as we know, has branches in most areas, including many rural locations, although the number of post offices is declining. And they also offer a range of financial products and services. You can have a post office current account, a card, loans, ISAs, life cover, home, pet, travel, and even car insurance through the post office. Now, some products are designed specifically to meet the needs of people on low incomes. So the budget card, for example, or the post office card account. Therefore, this can be quite attractive if people fall into that demographic. The post office is also quite attractive to people who maybe live in a rural area and do not have access or cannot access their banking or building society branch very often. Therefore, they can do the vast majority of their financial products and services at the post office. So, what are the advantages and disadvantages of different communication methods used by financial services providers? First one is postal banking. Many providers offer this service. You can mail in your checks, for example, for paying into your bank account, and also financial services providers might send you a statement through the post. The problem with postal banking, of course, is that it takes a long time. If you've used the post lately, you'll know that because of strike action, the time it takes to deliver your item may be substantially longer, and therefore postal banking may be inherently flawed for that reason. Of course, it also costs money to buy the stamp, so this costs money not only for the customer but also for the financial provider. Many financial providers have actually gone paperless with their statements now, so they are emailing them across. And that is not only perhaps more convenient for them, as customers receive it instantly, but also it means that they save an awful lot of money because they don't have to buy thousands and thousands of stamps. Internet banking is becoming very, very popular for many consumers. It means that people don't have to leave the comfort of their own living room and can still access all of their banking and financial information. They can do this through the internet or through, obviously, an app which the bank has released. The bank, it means that they have to spend money initially in order to develop the app or their website. There's a significant amount of security which is required, of course, when it comes to financial services. But it means that they can potentially not have as many branches. If the vast majority of their customers are doing banking through the internet, then they might choose to shut branches. And in fact, that has been a trend recently to shut banking branches. Face-to-face banking within the branch, of course, the traditional way of banking, and still used by many people who are potentially not internet literate and cannot access their banking needs through the internet. That means, of course, that banks need to keep branches open, which increases their overheads, and therefore they need to claw back these costs, potentially through higher interest rates to borrowers. Telephone banking is where we do our banking through the telephone. Of course, it's not ideal if we need to see things or we need to be explained things in visual form. Of course, it is useful, however, because we do not need to go into our bank. Telephone banking, I would say, is potentially used a lot less now internet banking is becoming so prevalent. And finally, app banking. Similar, as we mentioned, to internet banking, apps these days are extremely powerful. Those apps released by financial services providers, we can do all manner of things that we might have done in a face-to-face branch in the past, for example. However, there is increased cost for the provider. They need to launch the app in the first place, they need to maintain its quality, and they need to update its security measures from time to time, and therefore it also will increase their costs. So what factors should we consider when choosing a financial product or provider? Firstly, we need to assess our own personal circumstances. Is it that we are unable to access a branch that often? If so, it might be worth looking at a post office account if we have a post office in our locality. Alternatively, if we are internet literate, then it might be worth just finding a bank or building society or other financial provider that we can monitor our finances online or through an app. In fact, there are many banks which do this solely now. They're called challenger banks, or many of them are called challenger banks. Banks such as Monzo or Starling, they do not have any physical branches, and therefore they just do it through an app. You also need to work out what type of product you need. If you need a variety of different products, then a credit union may not be suitable as they only offer loans and savings accounts. You need to research the best rates available. Different providers offer different savings interest rates, for example, and therefore, if you're looking for a higher return, it might mean that you have to choose a different provider. You also need to look at how convenient the communication methods each provider uses are. For example, if you are particularly keen on having a branch to visit and speak to someone face to face, then a new bank account from Monzo or Starling who do not have branches would not be suitable for you. You also need to look at the values of the organisation. For some people, this is really important. For example, the co-op banks are known for being ethical in the way they deal with investments, for example. Of course, if you go for somewhere with good values, it may be at the expense of higher rates for interest on savings accounts, for example. Now, many people wish just to stay with their existing provider, and that's fine. It's continuity, and you do not have to learn a new app, for example, or go to a different branch. But it can also be detrimental to your savings rates or the amount you are charged for a loan. Many people find that by changing their provider or going to one of these new challenger banks, for example, means that they can benefit from a cheaper loan or mortgage. Alternatively, they might get higher interest rates on their savings accounts. And finally, what type of provider do you prefer? Many of us have grown up with certain banks or building societies. Maybe our parents were members of a specific building society, and therefore naturally we opened an account with the same provider. We might become comfortable with this provider, we might prefer them, and that's absolutely fine. But many people choose a provider or financial product simply because they like or prefer the provider. So, let's look at a written response question. This is going to be a great way to assess your understanding of this topic. It's a 5 marker and it asks you to analyse why many financial services providers are closing branches. For an analyse question, we need to fully explain and look at the implications of the specific point. So why do many financial services providers close their branches? It's a 5 marker, so we need a minimum of 2 points, ideally 3 or more. So firstly, branches are high cost. If you have a high number of branches, it inevitably means that you have high overheads. Of course, if you have high overheads, you'll have to pass these costs on to your customers, making you less competitive potentially compared to your competitors. The second thing is, if profit is purely their motive, it might mean that, yes, of course, closing these branches means you can reduce your overheads and potentially increase your profit. I say potentially because it might be that customers particularly value going into branch, and therefore, if you close a branch, it might mean you lose customers. Thirdly, alternative banking methods may be more popular. In the current age, we are becoming increasingly internet literate, and many people choose simply to bank via the internet or alternatively bank on their app. That means that for many people there's less need to go into a branch, and if financial services providers are experiencing lower numbers of people visiting their branches, they may choose to close those branches. Now, in some cases, some providers may merge or join. For example, the Cheltenham and Gloucester Building Society joined Lloyds Bank in August of '95. That of course means that in places where they've got branches for each provider, they may wish to close one or more of them. Because if you've got duplicate branches and you're the same organisation, it perhaps doesn't make sense from an overheads perspective. On the flip side, why might some providers resist the temptation to close branches? Or what might their decision depend upon? It could be that their market research they have carried out shows that their branches are actually a unique selling point. Many new challenger banks, such as Monzo and Starling, do not have branches. So therefore, if you are a Nationwide or a HSBC or a Santander, people who want to visit a branch are more likely to come to you rather than a competitor who does not have branches. It might also be that they cater to a large number of customers who are unable to use an app-based banking or internet banking. Potentially, we're generalizing here, but elderly customers may wish to visit a branch. Therefore, their decision depends upon whether their market research suggests that branches are a unique selling point and whether they cater to a large number of customers who are not using other forms of banking. There's also 3 multiple choice questions on the screen to assess your understanding of this topic. Firstly, building societies are mutual organisations, which means that they are owned by their A. Directors, B. Employees, C. Members, or D. Shareholders. The answer to question 1 is C. All building societies are owned by their members, i.e. they are mutually owned. Question number 2. Demutualisation describes the process of A. Banks becoming building societies, B. Banks taking over other banks, C. Building societies becoming banks, or D. Building societies taking over other building societies. The answer to question 2 is C. Demutualisation changes the status of a building society from being owned by its members to being a bank owned by shareholders. Question number 3. Most UK banks are owned by A. All account holders, B. The government, C. Their members, or D. Their shareholders. The answer to question 3 is D. Most banks are public limited companies and are owned by their shareholders. Make sure you subscribe for future videos and hit that banner to access the next video in the series.